This month on the podcast, Sean, let's talk about two advisors. Twice the wisdom, twice the fun, or twice the headache, right? So we'll talk about having two different advisors. And I want to make sure that we not talk about working with a firm that may have multiple people helping you, right? If you're working with a firm who has, like the lead advisor, maybe an associate advisor or something like that. I'm not talking about that. I'm talking about going to two different places, complete different companies to get, your finances handled or your retirement or whatever that might be, and why that can be a problem. And I'll set it up, Sean, here in just a second with an email that we got in. But first, how you doing this week? You doing all right?
Yeah, I'm good.
Yeah?
I'm good. Starting to cool down a little bit out here.
Yeah. Well, what do you think about this concept before I read you this email? Two advisors. Is that something you guys are okay with as a firm, or do you prefer to just, work with the person solely?
I mean, the preference is to work with a person solely. Do we have relationships with people that have multiple advisors? Absolutely, we do.
Gotcha.
But it's very well structured as far as what the expectations are.
Yeah.
And in a lot of cases, it's I've had my advisor for years, or I want them to focus on growth, or whatever it may be. But I always have the exact same conversation. And when it comes to having advisors that are in your camp, two of us that are working, there has to be communication between advisors. There has to be a mutual level of respect. But more importantly, the client needs to know who's going to lead on the advice giving.
Oh, great point.
What I mean by that is that if I'm not the lead on the advice giving, for example, and you're the client, I'm advisor A, advisor B is the lead on the advice giving. Well, if I give advice on, maybe we should take Social Security at this point in time, let's reallocate here to create income, whatever it may be, there is potential that information goes back to the advisor and advisor has a different opinion.
Yeah. Well, I want to talk about that. And kudos to you for even doing that, because I talk with a lot of advisors across the country, and they're like, "No, our firm. If you're not, if you don't feel comfortable with us doing the whole job, then we're probably not the right fit for you." So let's talk about a few pros and cons, and we'll start with this question that had come in from somebody listening. They said, "Look, for years I've had half my money with one person, a broker, and half with someone else. They're both awesome, to your point, but I thought it'd be cool to get advice from two different people and make sure things are, on the up and up. But now it just feels confusing to me, and I'm thinking about just going to one place." So let's start there, right? So you mentioned the fact that who's leading, right? If you're going to work with two different people, who becomes the quarterback of this financial team? And it's probably going to be me, like the client, right? As the person, you now have to do that. So the first question I would ask myself is, do I even want to do that? Because you're going to get that conflicting thing. To your point, how do you gauge the metric? If advisor A is all growth and advisor B is doing all conservative, and it's a banner year for the stock market, well, it's going to look like A outperformed the crap out of B. So how do you judge, right? So there's some things to think about. What do you think?
So here's how we work. We require to be lead. And the reason that I require to be lead is that I'm not going to put my name on anything that I'm not building out and confident in. Okay. I don't know what's happening on the back end. I don't know what's happening. So when we start to look at that, you look at, why do people have multiple advisors? Well, I don't want all my eggs in one basket.
Sure.
I want the ability to go out and have advisors compete with each other.
Right.
At the end of the day, the work that we do speaks for itself. I'm not in the business of competing with any other advisor, nor do I feel like I have to.
Right.
And so if our advice is valued, we're lead first and foremost. You can have accounts with somebody else because you've had that relationship for years, but we're overseeing the bulk of the strategy. We're overseeing the lead of the design of the plan and the execution of the plan. And that allows for that advisor on the other side to just do and focus on what they're doing. If you're going to focus on
growth,
lane, you just do that.
Yeah.
But it also tends to happen that you may have advisors from, I gave my nephew down the street a chance when he started at Edward Jones, and
right
there, and then Bill was in my church or whatever, and I gave him an account. But I kind of like Bill, so I'm going to leave that. there's a lot of reasons why people have multiple advisors, but you've got to have a kind of a lead engineer,
Yeah.
and that's okay to have that lead engineer. And as long as we're that, I'm okay having if you have other relationships.
Well, so let's point out some flaws in some of that stuff, right? So what are some hidden problems with having two or multiple advisors at different companies? You said earlier communication's key, but let's be honest, Sean, most of the time it's probably not happening to the level people think it is. It's not like advisor B is calling up advisor A and saying, "Hey, we're going to do this," and so just letting you know that that's going to affect things from a
Right.
tax standpoint, for example.
Yep.
That's a big piece of it, right? One conflicting reason to not have two is no unified tax strategy is probably going to be
Yeah.
happening.
Yeah. If you're going to have multiple advisors, have your non-lead advisor manage IRA money. There's no like it is what it is.
Okay.
It's easy to track. So lead advisor can then go ahead and say, hey, how much money are you going to pull out from this account on the outside? Perfect. Now we can build your tax strategy over here. It still doesn't allow for a lot of Roth conversions or the lack of clarity when it comes to, what did advisor A do over on their side that we didn't see as far as
Right.
trading. Because you do run the risk then if advisor A on the outside is managing the portfolio, but they really don't understand what we're doing, you could have conflicting strategies where strategy A looks almost entirely like what we're building out, and
Right.
now we have a lack of diversification. And your accounts are butting heads and they're less efficient rather than actually doing
Sure.
what they're supposed to and working in harmony.
Yeah, and let's not even forget about the fact that fees, right? We haven't even got to the fee conversation, but I want to start with what you said a minute ago. So you had said, hey, I went and got an account with my nephew because he started at Edward Jones or whatever. And you also talked about the fact that a lot of times the people get into this situation because they just think I'm more diversified. So here's an example we see all too often. So the client goes over here to this big box on the corner and they buy a mutual fund. And then they go over to another big name, box down the street and they buy another mutual fund. And then they go to another one and they buy another mutual fund. And they think, well, there are three different mutual funds from three different companies. So they're probably diversified differently. Therefore, I'm diversified differently. But when you go diving into it, it's almost always overlap because they're all typically in some sort of S&P or some sort of, large cap or whatever. So you're paying fees in all of those.
Yeah. Yeah, so there's really no efficiency, and take it a step further. Let's say that you've got a $1 million portfolio where, at that point in time, your overall assets are over $1 million, and you've earned the right to have a little bit of a fee reduction when it comes to advisory fees. Well, if you've got assets over in this area and this area, neither firm is going to give you a fee reduction based on the amount that they're managing.
Right.
When they should, if it's the overall amount, you're probably going to see a little bit of a fee reduction if all the assets are in one spot. Now, not having all your eggs in one basket, I understand that, but let's use Fidelity as an example.
Okay.
Fidelity is one of the largest policemen of assets, largest custodians in the world. Just because you have all your money at Fidelity doesn't mean that you're 100% exposed in the same pots, right? You could own a lot of different things under the Fidelity umbrella, but still simplify your life and having all of your money in Fidelity itself.
Right. Yeah. And I think the confusion, the amount of paperwork, I think all of that stuff, and again, to the point here of this person's email, we don't know how old they are, but I think anybody who gets over 50 starts to realize, hey, the simpler I can make my life, the better. Now, we're worried about our forever money, and I totally get that. But I think that as we start to get older, we want to have some simplicity and we want to have some unification so that we kind of really know where things are at. And there could be some one-off instances where multiple advisors work, but I think for most people, Sean, maybe unless you're really ultra high net worth or something like that, it probably just feels like more hassle, and it is more hassle than it may be worth.
Yeah, I would agree. I think that my advice is find 3 relationships that are really solid for you that work together: estate planning attorney, CPA, and a really good advisory firm.
Well, okay, if you're thinking about getting multiple pieces of information, there's a team right there.
There's
Like
your team.
you can still talk, bounce ideas off of one or the other, right?
Yeah, and find a team that's working together. The hard part is that advisors at competing firms, they all think they're better than each other. They're not going to want to work together.
Yeah. Well, and I'll add one more to the team too, Sean. A lot of financial firms, they may have somebody on staff and they may not, but they may also have several people they can refer you out to for the Medicare specialist, because that gets really complicated.
Yeah, I mean, we don't do Medicare, but the building right across the street from us, that's all they do. And so we started to build a relationship with them, and we're working towards saying, hey, any Medicare opportunity that our clients have that come up, we're going to refer them to a trusted partner. Same with estate planning attorneys, same with CPAs. We have all those relationships. Right. It doesn't mean that I want to do it. I don't want to be an attorney.
Right. So. Right. Well, yeah, you got to do all the extra stuff anyway, but that's the point. But now you as the lead, or you as the one sole financial firm, are the quarterback, right? So me as the client, for example, now I can go, cool, I got a problem. I'm reaching out to Sean and saying, hey, what are we doing about tax efficiency? And then Sean's going to give you that information that you then take to the CPA, and then they're going to do their part of it, right? So on and so forth. So it's about having that financial team, I think, versus just having multiple stuff out there. And I'll finish off with one final point, Sean. Right. The email starts with, I have a broker. And I think at a time of life that we're in, when we're younger, maybe having a couple brokers does seem like, because we're growing the wealth. Sure. But we're talking about preservation and retirement strategy. One's got to be the ticket, if you ask me, because there's so many moving parts. To your point earlier, if you pull one lever, it's going to have a cascading effect, 6 things down. And if the teams aren't working together, that's going to get missed. I
agree. And, kind of tongue in cheek, if you want 2 advisors, every meeting that I work in, I have another advisor with me. So there's your 2.
Yeah, exactly. Right. But at least it's in the same firm and they're all on the same page. So look, end of the day, right? Is it a good idea? Maybe, but probably not, right? So every situation's a little bit different. You got to see what feels right for you. But I think for most people, it's just going to be more trouble and more headache than it's worth. But that's why so many advisors do offer complimentary consultations and reviews. Go meet with a few of them and find out which one speaks your language. Find out which one, resonates with you, and then build that relationship. Because, I mean, Sean, you guys are looking for a long-term relationship too, right? Not to sound cheesy, but that's the truth, right? You're not looking to, Yeah,
we're not looking to just sell something and move on. We actually won't even hire advisors that's their mindset.
Right.
And we've got everybody that's on our team is service related, with the idea of building a plan that our clients can be excited about.
Exactly. I mean, if you're 60 years old and you've got a 35-year-old kid and you're working with an advisor, and that 60-year-old is, your advisor, they're probably going to want to have that relationship to be able to help your kid, generational and so on and so forth. And they can find their own as well. But that's the idea. You want to build those long-term relationships, especially when dealing with your long-term and forever money. So if you got some questions, need some help, reach out to Sean and his team, see if they're the right fit for you, right? And that's one reason why everybody and their brother has a podcast now too, right? It's a way to get to know them a little bit better and learn a little bit more about them and so on and so forth, and see who's the right fit for you. Go in for that complimentary consultation, have a chat. If you need some help, Sean and the team are here. Check the links below, click on the links to get onto the calendar and have a conversation, and reach out to them. Don't forget to subscribe to us on Apple, Spotify, and of course, YouTube. And we'll see you next time here on the podcast. Thank you, my friend. Have a great week.
Hey, thanks, man. You too.
We'll talk to you a little bit later here on Retirement Elevated with Sean Lee.
This podcast has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this podcast is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation, and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt, Mark Killian, and Third Wheel Media LLC are not clients of Elevated Capital Advisors. They receive cash compensation for their assistance in preparing and hosting this podcast, and for providing the endorsement contained in this podcast. Because Walter, Mark, and Third Wheel Media are compensated in connection with this podcast, they have a material conflict of interest in providing their endorsement.